What's up everybody, Genix Dividend Investor here. In this video I explain why the stock market is often seen as, and may actually be, rigged, and why, despite its flaws, I still choose to invest in dividend stocks. I'll also share the best shortcut to building wealth that I know of based on my experiences from investing for over 3 decades, so I encourage you to stay until the end. Now, the inspiration for this topic came from a recent conversation I had with an Uber driver. I usually try to influence people to invest when I have an opportunity to do so, and when I mention how investing can get you passive income and ultimately can enable you to retire earlier and better, he responded that he didn't invest because he thought the market was rigged. I asked him what he meant, and he couldn't name anything specific other than a general distrust for Wall Street. And I can understand that perspective given all the insider trading things that have come out over the years, along with the 2008 financial crisis. I mean, we've had the Enron scandal, which filed for bankruptcy in 2001 due to widespread internal accounting fraud, which led to the company's collapse and significant losses for shareholders and employees, as well as the dissolution of their accounting firm, Arthur Andersen, which was implicated in fraudulent practices. We've had Bernie Madoff's Ponzi scheme and a slew of other examples where financial mischief killed the common person. That kind of stuff unfortunately happens, and in fact just last week India's stock market regulators said that a former stockbroker made millions of dollars in illegal trade gains by using inside information from an unnamed overseas entity. They said that there are 22 people involved in this alleged illegal activity, which included front-running of impending trades of a big client. Front-running, also known as tailgating, is a prohibited trading practice that can resemble elements of stock manipulation and insider trading. It involves a broker using non-public knowledge of a large pending transaction in order to make personal gains. For example, suppose a broker receives an order from a major client to buy 10 million shares of company ABC. Such a significant purchase is likely to drive up the stock price in the short term due to the increased demand. And instead of executing the client's order immediately, the broker, acting unethically, buys shares of ABC for their personal account, or maybe an accomplice's account, beforehand. This initial purchase helps push up the stock price slightly. When the client's large order is then executed, it further inflates the price. The broker then sells the shares they initially purchased at the higher price, pocketing the difference. Ouch. Take a listen to this 2-minute clip of a case that happened about a decade ago, which exposed how high-frequency trading firms, or HFTs, used technology to rig the market, where they exploited millisecond differences in trade execution times so firms could front-run orders, profiting at the expense of other investors.
In the last 2 weeks, the New York Attorney General and the Commodities Futures Trading Commission in Washington have both launched investigations into high-frequency computerized stock trading that now controls more than half the market. The probes were announced just ahead of a much-anticipated book on the subject by best-selling author Michael Lewis called Flash Boys. In it, Lewis argues that the stock market is now rigged to benefit a group of insiders that have made tens of billions of dollars exploiting computerized trading. The story is told through an unlikely cast of characters who figured out what was going on and devised a plan to correct it. It could have a huge impact on Wall Street. Tonight, Michael Lewis talks about it for the first time. What's the headline here?
Stock market's rigged. The United States stock market, the most iconic market in global capitalism, is rigged.
By whom?
By a combination of the stock exchanges, the big Wall Street banks, and high-frequency traders.
Who are the victims?
Everybody who has an investment in the stock market.
Michael Lewis isn't talking about the stock market that you see on television every day. That ceased to be the center of U.S. financial activity years ago and exists today mostly as a photo op. This is the stock market that Lewis is talking about, the one where most of the trades take place now, inside hundreds of thousands of these black boxes located at more than 60 public and private exchanges, where billions of dollars in stock change hands every day with little or no public documentation. Trades are being made by thousands of robot computers programmed to buy and sell every stock on the market at speeds 100 times faster than you can blink an eye. A system so complex, it's all but invisible.
So basically what was happening, and is still happening to some degree, is that those high-frequency trading firms used technology to see orders from other investors moments before they were completed. With this tiny head start, measured in milliseconds, they would jump in, buy the stock first, and then sell it back to the original buyer at a slightly higher price, allowing them to skim small profits off countless trades. Now, while each individual trade might only involve a tiny amount of money, doing this thousands of times a day added up to huge profits for the HFT firms. Meanwhile, everyday investors, mutual funds, and pension funds unknowingly paid more for their trades. Basically what's going on is that when you place an order to buy or sell a stock, that order has to travel through various systems to reach the stock exchange. Think of it like sending a package through a series of delivery routes. HFT firms built faster delivery routes by using advanced technology like high-speed fiber optic cables and computers placed physically close to the stock exchanges. This speed advantage allowed them to spot your order as it was on its way to the exchange before it was actually completed. It's like if someone saw your package in transit, intercepted it, bought the item you were trying to purchase, and then sold it to you for a slightly higher price. By being faster, they could exploit this tiny time gap to make money, all without you realizing it. You see, in the background, our modern stock market is fragmented across multiple exchanges like NYSE and NASDAQ and many others, and trades are routed through these exchanges based on pricing, speed, and liquidity. When a large order is placed, it often gets split across multiple exchanges to fill at the best available prices. HFT firms could detect the arrival of an order on one exchange and predict that there are unexecuted portions of the order heading to other exchanges. They'd even sometimes flood the market with fake orders, a practice called quote stuffing, to slow down competitors or manipulate prices. This created delays in processing real orders, giving HFTs time to execute trades ahead of others. Sometimes they got away with it, and sometimes they didn't. For example, in 2015, the SEC fined a subsidiary of Bats Exchange millions of dollars for failing to properly disclose order types that favored high-frequency traders. But eventually, a variety of guardrails were put in place to try to limit stuff like that happening. Like the IEX exchange introduced microsecond delays in order to slow things down and remove any speed advantages. And new regulations were put in place to stop manipulative practices. Reforms were enabled to require brokers to disclose how they route orders, reducing conflicts of interest. But instances of misconduct with front-running continues to happen. Like in 2019, Tower Research was ordered to pay $67 million to settle allegations of spoofing, which is placing and then quickly canceling orders to manipulate market prices. And in 2023, Citadel Securities was fined millions by South Korea's financial regulator for distorting stock prices through the use of immediate or cancel orders and by filling gaps in bid prices. Part of the challenge is that the rapid evolution of trading technologies and strategies often outpaces regulatory frameworks, making enforcement a continuous endeavor. And I should mention that while instances of misconduct have and do still occur, not all HFT activities are illegal or harmful. What I mean is that many HFT firms contribute to market liquidity and efficiency. Nonetheless, the potential for abuse necessitates ongoing monitoring and regulation. Critics argue that market structures still incentivize speed over fairness, particularly with the prevalence of maker-taker pricing models. Many retail investors' orders are still routed through payment for order flow systems, raising questions about conflicts of interest. So while steps have been taken to make financial markets fair and more transparent and less rigged or riggable, the reality is that things aren't always a level playing field. And unfortunately, there are lots of other cases where things are shady in the market. Like take short selling, which is legal, but can be illegal if manipulative practices like short and distort are used. Short selling is a trading strategy where an investor borrows shares of a stock and sells them immediately, anticipating a decline in the stock's price. If the price drops as expected, the trader repurchases the shares at a lower price, returns them to the lender, and keeps the difference as profit. But to try to ensure the stock price drops, an illicit trader might spread false or misleading negative information about the company. This could involve rumors about bankruptcy, fraud, or bad financials. The negative buzz can cause panic among investors who might sell their shares, driving the price down. The short seller then buys the stock back at the now lower price, profiting from the decline they caused. This practice obviously harms companies by damaging their reputation and destroys investor confidence, which is why it's illegal. Regulators like the SEC actively investigate and prosecute such cases to protect market integrity. And oftentimes size matters, that's what she said. What I mean is that there is a preferential treatment for large institutional investors. They often have access to better research, faster execution speeds, and tailored financial products, putting retail investors at a disadvantage. Like think about IPOs. IPOs are often allocated to institutional investors or high net worth individuals, leaving retail investors to buy shares at inflated post-IPO prices. So there's lots of ways that we retailers aren't on a level playing field. For example, consider dark pools and off-exchange trading. Dark pools are private platforms where big investors trade stocks without others knowing what they're doing. They were created to prevent large trades from affecting stock prices in the public market. However, because these trades are hidden, everyday investors don't get to see important details like prices and trade volumes. This lack of visibility can make it harder to understand the real demand for a stock. So while dark pools have valid purposes, they can make the market feel less fair and less transparent for smaller investors. Another way markets can be manipulated are by media and analyst influence. Like relationships between companies and individuals can cause biased information to be released, which can move the markets. Maybe analysts are working for firms that underwrite the companies they're covering, or whatever. And think of all that stuff going on in the news these days about folks in Congress who are buying and selling stock, potentially with information we don't have. So given all that, why would I still invest? I mean, if the game isn't totally fair, then why play? Well, for a bunch of reasons. One is that the stock market has historically been one of the most reliable ways to build wealth over time, even accounting for market manipulation or structural inefficiencies. I've experienced how staying invested allows participation in the growth of the economy and businesses, all of which typically has outpaced inflation over time. Plus, I've seen that other investment options, like bonds and precious metals and such, haven't offered the same potential returns, and real estate is too stressful and time-consuming for my tastes. I personally love investing in quality dividend stocks as I want consistent passive income with some growth along the way. And even in a manipulated market, dividends are a simple and direct benefit from holding shares, a benefit that is tangible and right now. Of course, I almost always recommend that most folks just stick with index ETFs, which provide diversified exposure to the market, reducing the impact of manipulation to some degree of individual stocks. Investing has shown me how decades of compounding in tax-advantaged accounts, like IRAs and 401ks, yield awesome returns over time. And I've seen how I can utilize tools like FastCrafts to help me identify and buy undervalued stocks, which helps me improve my returns over the years. And I'm an affiliate for FastCrafts, which you can find in the description of this video. So TLDR, things may be rigged, but they aren't so rigged that I avoid the gains. Plus, I think that regulatory bodies like the SEC will continue to put checks in place which should help avoid widespread abuse, and while they aren't perfect, they're better than nothing. And I believe that market corrections often act as self-correcting mechanisms, helping to restore level playing fields over time. And maybe I have a little bit of FOMO in me, and I don't want to just sit on the sidelines as the markets trend up. I've seen too many of my friends and relatives quit investing over the decades for a slew of reasons, and while I've had to take more gut punches remaining in the market, I've also got to experience lots of gains. So even if the house has an edge, I still find that the potential rewards of investing make it worth staying in the game. I like to invest in proven, blue-chip dividend stocks, as I feel they help lower my risk a bit due to their histories, even though I know that all that really matters is how they do in the future, not what they've done in the past. I've seen my net worth grow up by a ton by merely buying and holding good companies. I've seen the power of quality dividend income trend up over time, eventually getting to a point that I could retire while I was still relatively young. Investing has been the best financial decision I've ever made, and I've not found any other way which is so easy to slowly grow your wealth. And while I'm confident that we will experience multiple huge crashes in our life, I still think it's prudent to invest. I want to own pieces of great businesses, ones that I believe will continue to sell their products and services even if we have a terrible economic crash. Even if we have a depression, I think people will still use their phones. Even if we have another 2008 or worse, I think people will still buy toilet paper and will still use electricity and will still spend money on businesses I tend to invest in. We might be in an era where the current generation of younger adults look like they're going to be worse off, on average, than previous generations have been for a variety of reasons. Housing is harder to acquire, college is more expensive, healthcare is out of control, etc. Our politics are as divisive as I've ever seen, and yet I still believe that investing is the way to wealth. And speaking of politics, take a listen to this quick Buffett clip that talks about how he could solve our US deficit problem pretty easily.
I can end the deficit in 5 minutes. You just pass a law that says that anytime there's a deficit of more than 3% of GDP, all sitting members of Congress are ineligible for re-election. Yeah. Now you've got the incentives in the right place, right? So it's capable of being done. And they're trying to use the incentive now that we're going to blow your brains out, America, in terms of your debt worthiness over time, and that's being used as a threat. A more effective threat would be just to say, if you guys can't get it done, we'll get some other guys to get it done.
Nice. Buffett always has the answers. And Mr. Buffett's lengthy career with investing reminds me of the best shortcut to building wealth that I know of, which I came to realize over time. The simple truth is that the shortcut to true wealth comes from investing for decades. So yeah, the shortcut is that it takes a long time. Now you might be annoyed hearing that, because perhaps you were hoping for some big secret to get rich quick. But the reality is that it's unrealistic to think that true wealth will have shortcuts for the majority of folks, and so instead of being annoyed, I'd encourage you to be excited by realizing that you too can truly become wealthy over the course of your life. I mean, only about 1.5% of people in the world become millionaires, and I'm very confident that you can become a millionaire if you invest non-stupidly for multiple decades. And sure, you could argue that $1 million portfolio isn't wealthy, but in many locations around the world it still is. I mean, this global wealth pyramid from last year shows that only about 16% of people are above the 100K net worth mark, so that amount should also be considered getting into the wealthy range around the world. And dividend passive income gives me the freedom to be able to live in countries all around the world that have much cheaper costs of living, making my dividend dollars go even further. Most people in the US who retire end up only having Social Security for income, but you guys watching this right now will have dividends flowing in as well. So as long as you stay true to your investing, then you should end up in a great spot. You guys are smart enough to know that if you chase super high yields from super risky stocks, then you'll probably not do so well over the long run. Remember the great Peter Lynch quote that goes, "People who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Calamitous drops do not scare them out of the game," end quote. So keep growing your stable of income-producing ponies, as those workhorses can keep winning and paying you more over time. But also keep things in perspective. There's another good quote that goes, "Wealth is like seawater. The more we drink, the thirstier we become." The point is that while it's important to invest and to prepare for your future, what truly matters in life goes beyond your stocks. Take a listen to this 50-second clip.
I have stood at the bedside of maybe thousands of people as they took their last breath. What people say in their final moments is pretty important. They don't mess around. When people are dying in their last words, nobody has ever said, "Pastor Rick, bring me my trophies. I want to look at them one more time." Or even, "Bring me my college graduation certificate. I want to look at it one more time." When people are dying and they know their time is short, what they want in the room is not things or trophies or achievement. What they want are the people they love. Eventually, we all figure out that it's all about love. It's all about relationships. I just pray you'll figure it out a whole lot sooner.
Something to think about as you continue on your journey in the world. And now please think about hitting that thumbs up button, subscribing if you haven't yet, and clicking that bell notification. Also consider sharing this or any of my videos with someone you want to help. That action could literally change and potentially save someone's financial future. Okay, now I'd like to shout out my newest Patreon aristocrat, PS 262626. I'd also like to call out Jas Freedom, who just signed backup. And I'd like to shout out my newest channel member, Mr. LRob213. Channel members get a variety of perks, such as the ability to watch my videos before I release them publicly, and they get a vote on which thumbnails I use, and they get a special badge icon by their comments, which levels up over time, amongst other things. Finally, don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 83 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.